Hi everyone, in this video I'm going to answer if Teladoc Health stock is a buy right now. Use 5 different metrics to make this decision, so let's get right into it, starting with quarterly revenue growth. Teladoc grew at a 17.2% rate in its most recent quarter. Of course, during the depths of the pandemic, revenue growth absolutely exploded for Teladoc, jumping all the way up over 150% for a few quarters, as people did not want to go inside doctors' offices where people were potentially sick and expose themselves to a potentially deadly virus. So they were having an increase in demand for these virtual teledoctor visits, right? And I perceive that in the long run, this is going to be a continued growing industry as people do not like going to doctors' offices. It's a hassle. You got to look for parking. You got to wait in the waiting room. Many times, as you all know, doctors overbook their appointments. So even if you go for a 1 p.m. appointment, you sometimes wait until 1:45 to be seen by a doctor. If you're going to be waiting, you might as well be waiting at home, and you don't want to go all the way to a doctor's office. This is especially more important for elderly folks that actually require visiting doctors more often, because moving around is can be a lot more difficult for them. So the growth in this industry, in this space, I believe is going to be long lasting. It's still relatively small compared to overall doctors visits, virtual visits, and so I think the growth will persist longer term. The next metric I wanted to look at is cash compared to long-term debt. Teladoc has 900 million in cash compared to 1.22 billion in long-term debt, and it's been doing a good job paying down its long-term debt. It went from over 1.4 billion in long-term debt to 1.226 billion, and that's good news because interest expenses are rising. So the more it can pay down this debt and not need to refinance at higher interest rates, the better it will be for its sustainability and its long-term prospects. The next metric I wanted to look at is its operating profit margin over the trailing 12 months. And what I see here is that it was rising and then collapsed January 2021, and it's been making its way back up from negative 40% operating margin to negative 10%. Although from January 2022 until now, it hasn't made very much progress in terms of improving profitability prospects. The next thing I wanted to look at is cash flow from operations over the trailing 12 months. And in this metric, if we look longer term, well, the longest that we have for this company is about 5 years. If we look across the 5 years, we can see an upward trend here for Teladoc going back from before 2019. It's been rising. If we ignore this kind of dip here, if we just draw a line from this area up to this area, we see negative cash flow from operations to turning positive 206.95 million in cash flow from operations. So nice demonstration of increasing cash flow as revenue has grown, and if it continues on that pace, it's likely to increase these cash flow from operations even further. So finally, I wanted to look at valuation to determine if the stock offers a good value, a good risk versus return to investors right now. And I chose to use the price to free cash flow metric because the company is not consistently profitable on the bottom line, but it was delivering positive cash flow. So I chose to use this metric instead of something that was related to sales only. According to this metric, the stock is trading at a price to free cash flow of 71.76. This is the lowest it has traded for going back several years. It was way more expensive. So relatively, it's inexpensive according to its past, but on absolute terms, a price to free cash flow of 71.76 is expensive. That's an expensive valuation, and I don't know if I would want to pay this kind of expensive valuation for the stock right now, considering that it's entering into a phase where it's going to face some headwinds into growth. It grew very rapidly during the earlier stages of the pandemic, and now folks are returning to some pre-pandemic habits and visiting the doctor's office, and it's going to be more challenging for Teladoc to capture the industry growth, right? It's going to grow. I think the industry overall is going to grow because of the convenience advantages I mentioned earlier. However, I don't think it's going to grow very fast. I think folks are going to be hesitant to switch over, and and the current population is maybe stuck in their older habits, and the as the cohorts, the newer tech, the younger tech savvy cohorts age, that's really the cohorts that's going to adopt this technology in more broadly speaking. So this company is going to grow. However, the growth rate I perceive is going to be slower. And so I don't want to pay this kind of premium valuation for an unprofitable growth stock right now in today's markets with the cost of capital rising. All right, so that's all I've got for this video. I truly appreciate your viewership. Thank you for tuning in and thank you for watching. I hope you'll see me next time for another video. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.